good morning. Welcome to Charting the Markets on this Thursday, the 11th of January, 2024. And we've got what is the second piece of big data out so far this month. Today, we've had jobs last week and US jobs, and today we got US inflation. Now, this is expected to give us some firm direction on the Fed's thinking on whether or not they have the capacity to cut interest rates come March. And there's a lot of pricing in the market where people believe that this is still bound to happen. The question is how much it could be steered by some unwanted strong data today. We've just been hearing from John Williams, the Federal Reserve chief at the New York Federal Reserve, talking about the fact that the Fed is situated quite nicely, but he wants to see evidence that interest rates can only come down, or wants to suggest that there's only an evidence to interest rates will come down if we see inflation start to drive down towards 2%. And that doesn't look like it's going to happen today, according to the consensus for the CPI print. Now, let's introduce our guest for the next 15 minutes, Serge Berger from thesteadytrader.com. Serge, welcome. Happy New Year to you. We haven't spoken to you so far yet this year, so it's our first opportunity to get up to speed with you and what you're thinking of at The Steady Trader. And let's begin, first of all, with your thoughts on the markets as presented to us, given the fact that we've got this CPI data out today. How do you approach this from a trading point of view?
Yeah. Good morning, Jeremy, and Happy New Year to you and the team as well. It's great to be here. So what we have seen over the course of 2023, we can go back further, but I think it's a good reference point, is the correlations between assets. And so typically, when I talk to our clients, I want to make sure they are aware that the equity market is essentially the tail that's being wagged by the dog and not the other way around. And so what I thought we could have a look at here, Jeremy, would be a correlation chart. So it's a multi-line chart, if you want to call it that. And basically, it's got 3 lines. Now, 2 of those lines have been going lower and one of them is going up. What are they? The line that's going up, or has been going up since late October, early November, is the US equity market. So it's the S&P 500 as represented by the SPY ETF. The other 2 lines that have gone completely inverse to the downside are, number one, the dollar, and the other thing is 10-year yields, or just bond yields. The whole yield curve has seen yields drop. Why is that important? It's important because we can't possibly get the equity market right unless in this environment we have a good handle of what the dollar and rates are doing. And if you go back a little bit further in that chart, you can see that inverse correlation holds the other way around too. So for example, when equities topped in July of last year, it's more or less just a little bit before then the dollar and rates bottomed and started going the opposite. So the question, of course, is what now? When I talk to people here in the United States about the inflation and just being here and feeling it, I do sense, and I think also the way that people positioning is that the expectation for inflation to further decline from here in a meaningful way is probably overdone. So line is, I would probably imagine that rates from here remain stickier than anticipated, and that could either come after today's CPI. We have PPI, producer price index, tomorrow. We get earnings season kicking off tomorrow as well into next week and the next few weeks. Then we have Davos. So there's a lot of stuff here to confirm or disconfirm what we're looking like in terms of equities. Risk assets. I would imagine that the dollar gets a bit firmer here, inflation remains stickier, and that probably would keep the upside in equities firmly in check.
Yeah, let me just take a look in some more detail about what's happening in terms of some of the dollar trades. You're talking there about the dollar's movement there in the same direction as rates. What about, let's say, I don't know, euro dollar or sterling dollar? Do you have a potential sort of position you could talk about on a trade that will be familiar with IG clients?
Yeah, no, for sure. So the way to think about it then would be if the dollar really gets stronger for a trade, right? We're talking about a trade, which that could be anywhere from a few days to a few months. then what has become a little bit consensus, meaning euro dollar going higher, would essentially reverse. So that would mean that euro dollar, in my view, is probably going to be, before we know it, closer to, let's say, the 1067, maybe 107 level. That's enough to cause pretty decent gyration. So the way that I'm trading this, I'm certainly going to wait for CPI, and the first reaction tends to be the wrong reaction. So what that means is patience. So at the very earliest, maybe late today, a few hours past CPI, possibly on Friday, if we were to see a negative reaction in the euro, so euro dollar lower, need that be confirmed, I think I would be happy to go short euro dollar towards 107. At the opposite, of course, I have no problem leaning in that direction, and then it's 112, 1.12 in euro dollar. But again, we need patience, and the market needs to digest this information. It's a really big data point.
Yeah, and as you say, all down to this data in 3 hours' time. We've spoken about the correlation between, or the inverse correlation between gold and the dollar before, and you've highlighted this trade. This is an interesting move. And again, let's take your point that you think that inflation is going to be stickier than anticipated, and the dollar perhaps maybe gets a little bit stronger from here on. This presumably means gold is vulnerable to a sell-off again.
Yes. So with gold, it's yes, the dollar, but it's really about real interest rates. So if that correlation holds that we spoke about before, then what I would anticipate is, if rates start to firm up a little bit again, then that basically would mean that gold, real interest rates, are going to be less negative, more positive. Excuse me. So there's an inverse correlation. So you can think about it just as treasury notes. So if treasury yields go higher, the dollar gets a bid, then again, gold is going to find that more difficult. So then we're in a situation where we have gold here on this longer term chart. Then we're still contending with, let's look at gold futures, might be the best way of doing it. We've had a really nice move, yet we find it really difficult to get past, let's say, 2100 or so on gold futures. Big point. It's a big point. And again, I just wouldn't make it too complicated. If we see it break above there, on a weekly basis, then that's long gold. In the meantime, it's a trading range. And I think one of the things about gold to keep in mind is a lot of times it is very choppy. In fact, it's been choppy now since April of 23. We had a big move in the fourth quarter, but everything had a big move in the fourth quarter. But really, we're just back to where we were. I think ultimately it's higher. But again, we need confirmation of that move. And it's most likely not going to happen with real interest rates going back higher for a trade.
Yeah. Just taking a look, if we can, at some of the potential moves in equity markets. If we see that there's this potential stickiness in rates, it's not good for stocks. But we've seen stocks buck the trend last year with record highs for pretty much all of Wall Street. And we're dancing around those records again at the moment. But as we've spoken about before, when looking at some of these stocks that have made the moves, it's centered around this core of really big, massive stocks that twist the whole index: the Microsofts, the Apples, the Amazons and Nvidias and so forth. What's your choice on a trade around some of these big stocks that we've been talking about before?
Yeah, it's super important, and it might be from a retail investor's perspective, might be the most important thing to be aware of. So what I'm concerned about, and I've been concerned about it maybe too long, but it's just gotten worse and worse, is the concentration risk, as you call it. What we want to think about, though, is not so much the risk in terms of a trade, but what does it mean for an institutional investor if they have to withdraw some money, or maybe they get withdrawals from their funds. So you think about a typical hedge fund or a lot of investors that are really closet indexers. the way they are positioned is dramatically overweighted these stocks because that's what the indices, the benchmark has. So if we get to a point, and this is the correlation, this is just Microsoft, NVIDIA, and the S&P 500, it's the same chart, right? So see a situation where there's a risk-off event. That could be political nature, it could be economic in nature, it could be, a bankruptcy or something that typically happens after rates spike, over the past 20 months. That could cause a waterfall effect of investors, professional investors, institutions having to sell the stocks they own most of, which is these few stocks. So there's a cascading risk here of that. In the meantime, of course, it's trend following and it works. The problem with trend following is that it can mean revert extremely quick. We actually bought NVIDIA 2 days ago. We sold it again yesterday just for a quick 4% gain. But I have really no interest in being overly exposed to these stocks, even from a trading perspective, because I think once we see mean reversion, it doesn't come, it won't be gentle. It'll be the first 5, 10, 15, 20% will be very, very quick. And I think what investors have forgotten is that will wipe out many, many months of gains, not just from a trading perspective, but also from a portfolio perspective. And so I think the risk here is very high, not because they're bad companies. These companies, Apple can correct 30% and still be a great company, easily, 40%. And they do that over time. But I think, if one is threading the needle here and doing trend following, just think about what mean reversion looks like. The first 15, 20% happen so quickly that they wipe out a lot of portfolio gains. So the question is FOMO really the way to do this, greed, or maybe do we want to be a bit more cautious?
And I suppose the way to trade this is you make sure you have a stop loss just underneath where you are. You keep on bringing that stop loss up to lock the profits in and make sure it's a guaranteed stop loss, because if there's a gap, you want to make sure you're stopped out to stop any
Yeah, that's
losses.
right. You want to use a trailing stop with something like this. And then I think at this point, these things are, and it's all algo driven, right? So NVIDIA, there's a great story for sure, but if that's the only stock that's going up every day along with Microsoft and a couple others, which have factually made up most of the percentage gains in the S&P 500. Again, it's a question of how much am I willing to risk to make a little at this point. And so a trailing stop makes a lot of sense. Just keep in mind, Microsoft and all these stocks, they have routinely over the course of time, like a 10, 20% correction is really nothing. Yet that could really, really sting people's portfolios at these levels. So I would just be a bit careful. Doesn't mean we have to short them though. That's a whole nother story.
Yeah. That's for another time. Look, Serge, thanks so much indeed. It's a pleasure. Thank you for your time.
Likewise.
Taking us out. Very early doors, of course, in Palm Beach at the moment, but enjoy your stay over there and speak again in a month's time. Thanks for your time.
Thank you.
That's Serge Berger from thesteadytrader.com talking about the markets ahead of that CPI data out at 1:30 p.m. today, UK time. We will be live on the IG platform taking you through that data and taking out what it means for the Fed come March.